Thank you all for coming. It's our 8th annual conference. Please, while I speak, feel free to get food, coffee, a drink. We were expecting a record number of people today, and we still have a record number of people, just on the south side. We were expecting close to 70, but unfortunately the weather, and that's it. This is a good event, I think, because I just give a lot of information on things that we do and how our processes, what we're thinking. If you have a question, please just ask it now or ask it later after I speak. I don't envision I'll be speaking for probably for an hour. I don't know what the over/under is, Tom, on this.
I can't say.
So, oh, you can't say. So just this evening just gives us gives you a little insight on what we do and so forth. We're not going through the handout. I'll select a few pages, but as you go through it, if you have questions on the handout, please feel free to ask. There's no question that you shouldn't ask. Perhaps I'll say I can't answer it for one reason or another, but ask anything. And once again, please just get up and get a drink, and feel free to get food, and return visits are welcome. So let's see, I'll start off with a joke. A man went to a doctor. No, I'm not saying that joke. Kim said I can't tell that joke.
Great joke.
So anyway, this is true. I was at a restaurant the other night with Kim and her mom, her 62-year-old brother, which is important to know, 62 years old, and his fiance, and me, and I'm 59 years old. We had a real nice evening together, and they all left. And the table next to us, there was a mother and son, and I took the mother to be about 75, and the son I subsequently found out he is 54. So she, and I'm 59. So we were talking about my kids, and I go, my oldest son is 26, lives in Oregon. But then she goes, oh, maybe your son graduated with one of my kids. I'm like, oh, what year? She goes, 1982. I'm like, well, I look a lot older than I am. I'm only 59. And then she goes, well, was that your son at the table? Referring to my 62-year-old brother-in-law, who really does look in shape. And that's true. But then that reminded me of a story that Abraham Lincoln told. Abraham Lincoln, I've studied him a great deal. He liked being called Abraham or Lincoln, anything but Abe. He hated to be called Abe. Well, he told a story, and he was once splitting rails, and a man came up to him carrying a rifle. And he demanded that Lincoln look at him directly in the eyes. And Lincoln stops what he's doing, obliged the man, and he stared silently in the guy's eye. And the guy goes, the man told Lincoln, for years I promised myself, if I ever found someone uglier than myself, I'm going to shoot him dead. And Lincoln looked at him, kept staring, removed his chest and goes, go for it, because if I'm as ugly as you, I want to die. Okay. I always start this, I don't read from things, and I try not to, but I always start this discussion with what I call a pledge of sorts. Me and our company, we have great responsibilities managing clients' money, and we take that responsibility very seriously. We're stewards of their capital, and we put their portfolio in front of everything, including in front of ourselves. It's very important. There's nothing I care more about than our clients' portfolios. Doesn't mean they'll always do well or that they won't do poorly, but the effort is always there. That's a fact. During the presentation, you're going to see I might look at my notes, especially during questions. I carry these notebooks with me all the time. These books, these are my well, the black notebook is where I keep a lot of information that remind me of things, because I just don't remember details. So, if I look at my notes, it's just because that's a little flaw I have in my life, and this is how I deal with it, with a lot of notes. And our website is the same way. It's such a wealth of information if you ever spend some time on it. And I found out, I finally thought about it about a month ago. I remembered in first grade, I wanted to be in a play, but I couldn't memorize the lines, so I couldn't be in a play. And that's, to this day, I just can't remember things of detail. Yet I could remember most conversations any of us ever had with each other. So. I want to introduce, and if you could stand up when I introduce you, I want to introduce my partner. We've been working together for 31 years, Alan Storinsky. He runs our accounting firm. And then, this is our staff who I'll introduce. 7 of us have been with the firm an aggregate amount of 176 years. So, there's Donna Wizendiski, no, Donna Mann, and then Denise Acasella. Chris couldn't make it because of the weather. Debbie, she just joined us recently, 12 years ago. She's our newest employee. And Jim Katz. So we all work together, we all get along. I think, I say this every year, I think we get along very well. Kim, and my wife Kim right here. We'll be celebrating our 29th wedding anniversary in a few weeks, right? In 11 days. So, very quickly, Henry, you had asked. We managed, as of December 31st, 54 million and change. We're right around there again because of this little drop. And very important is that's a dish I made a couple of years ago. I eat my own cooking. What I put in my clients' portfolios, we put in our families' portfolios, and we feel very strongly on that. And these pages, you'll see on pages 8 or as you go through it, these are our returns, historic returns. Everything I mention is as of October 31st, 2018, unless I say otherwise. And then through there you'll see our returns. Since we've been doing this 1998, we're on our 21st year of reporting results. You'll see in there the books I read, 43 books last year. That's a lot of books. Buffett says, read 500 pages a day. That's how knowledge works. It builds up like compound interest. And then I will go to compound interest. And this is a slide I'll spend most time on, but I've talked about this every year. Is anyone not familiar with the rule of 72? It's very simple. So the rule of 72 is very simple. And Einstein said that compound interest is the greatest mathematical discovery of all time. Very interesting. And there's rumors, and I couldn't really fact check it. There's rumors that he thought the rule of 72 was great also. But all the rule of 72 is, and it's important for this discussion tonight, it's how long will it take at a specific rate of return or interest, how long will it take to double your money? So 72 is the numerator on top, and then the denominator is the interest rate. So historically, the 3-month treasury over 84 years has been 6%. 12 years, 72 divided by 6, 12 years to double your money. You can see here in 2008, the 3-month treasury was at 0.001, 7,200 years to double. And look how it's gone in the last 10 years. It's gone all the way from 7,200 years to 31 years. Still a long time, still way under. The 3-month treasury at 2.3% is still well under our historic average. So does everybody understand the rule of 72 now? And it makes sense? If you're investing and making 10% on your money, you'll double your money in 7.2 years. And of course, that's a generic formula. The higher the rate of return, the less exact it becomes, but it's never off by more than a few months. This is just various rates we present every year. And here's the rates as 1031.18, money markets, 6-month CDs, 5-year CDs. I bolded them because you could see we're at 8-year highs on every one of those rates. Good to know. We include this every year. Here's a 10-year Treasury all the way back from 1790. I like to look at household debt and to see if we're putting ourselves in any type of trouble, any type of 2006 situation. And you can see 2006 here. Debt levels were quite high, but it seems here that we're pretty much at a 38-year average. Does not seem excessive. And I'm always looking for those things. As the markets were at all-time highs, and a bull market where things have increased maybe 300-400% since the financial crisis, I'm always looking for things that could get in our way. Not that we'll find them. I've always told our clients if there's a bear market, we will not avoid it. We might, because we're typically defensively positioned, we might avoid it less than others. But even this time, we were beating the S&P quite a bit all year. But now that oil is down 20% over the last month, we've taken a hit as well. We're still outperforming the S&P, but hardly by the magnitude, by maybe 1% at this point. But that's not our goal. It's not to beat the S&P. Our average dividend on portfolios, our average the average dividend as of October 31st was 2.8%. Now it's a little higher because prices have gone down, dividends stayed the same. But that's a nice dividend where our dividend is we like to invest in companies that carry 66% of the 5-year Treasury. So 2.8% is still well above that rate, and it gives us a margin of safety. So as I said, this is pretty normal. It looks like the next chart, consumer confidence, 98.6. That sounds very normal, doesn't it? Yep. That's a dead joke. You got it, Ken? I'll get into consumer confidence later, I believe. But it's a very healthy number right now. Actually, it's near the 4th highest level that it's been in quite a few years. And consumer confidence, if people are confident, they'll spend. In 2006, or in the crisis, you see where it plummeted. And people were scared to spend money. I remember, it's just a very difficult time. This is the price of natural gas. To us, natural gas is very important. I was hoping that a friend of mine was coming who's a high-level executive at a utility company, and I was really eager for him to hear some of the things I had to say here, but unfortunately he's not here. The reason natural gas is so important to us is several reasons. The primary reason is we invest in utilities. We're heavy utility investors. Utilities typically, but I'll get into that, typically, but not always, offer a safer means of investing. Your typical growth in a utility, your return on investment typically will not be as great because of the safety nature. The government limits how much they can make. but they also limit how much they could lose by dictating the prices that they could charge, the regulators. The prices they could charge are typically based on natural gas prices. So PSE&G, they use natural gas, it gets passed off to us as consumers. So our prices, the price we pay is based on natural gas. Now natural gas has gone up quite a bit this year, and perhaps we'll start seeing that in our bills, our utility bills shortly. We own a company called Exelon. That's our 6th largest holding, and that's noted in the handout. And Exelon is the largest nuclear utility in America. But yet their pricing is still based on the price of natural gas. So the beauty there is when natural gas prices are going up, their costs are not going up because the utility has nuclear generator has fixed costs. So they'll have a higher profit because the price of natural gas is going up. On the other hand, you also carry the risk of a nuclear mishap. Another reason we like to look at natural gas is our 2 largest holdings are the 2 largest natural gas and oil producers in the world, if I'm not mistaken. That would be our largest holding is Gazprom, which is controversial, 50% owned by Russia, a Russian company, and I'm sure many of you have heard of the situation with Russian oil and gas. Not always, in my opinion, portrayed as it is, in total honesty to us. And Exxon is also a very large natural gas company, and as the price of gas goes up, even though oil's going down, it'll be interesting to see their earnings. I wouldn't be surprised to see them have pretty decent earnings going in the future, even with oil being so low, or getting lower. Let me just finish my thought, Alan. Well, that's it. Now, natural gas also is well, I'll get it to you later. Yes, Alan?
What do you feel, why is oil going down? What's your thoughts?
No, I never know what prices are going down, and I don't think, they talk about supply, too much supply, and so forth. But who knows, prices, I really didn't expect it to be as low as it is. Certainly they're having pressure from the president, our president, but I don't know the reason, and we'll find out. And I'm surprised. You're seeing a lot of volatility in commodities, even natural gas. I wrote that at the end of October, where this is reported, natural gas was at $3.72 per. I think they call it a bushel. I forget what it's called actually. Yesterday it was up to $4.70. I was just shocked at how high it went. $4.68. Well, today it was down to $4.08. So you'll see in the paper how it plummeted tomorrow. But it's still in the paper tomorrow. You'll see how natural gas plummeted today. But it's still well above October's levels, and it's also natural gas is 72% off of its highs over here, which was, I think, 13 years ago. So it'll be interesting to watch natural gas. I totally think it's going to go up. I think it'll benefit companies like Gazprom, like Exxon, especially with liquid natural gas becoming big and us transporting to Europe, as that's a major goal of our administration, is to get Europe to buy our gas as opposed to Gazprom's. It's a very interesting dynamic, because Gazprom, Russia, has inexpensive and high quality natural gas, and to get it to, let's say, Poland or Ukraine, it's a lot cheaper than us transporting it halfway across the world. So it'll be interesting to see how that works out. Yet Poland just signed a major agreement with Cheniere Energy to supply natural gas. So we'll see what happens there. So my answer to your question, Alan, is I don't know, and I don't think anybody knows. It's supply and demand. It's OPEC. It's politics. I think it's impossible to know that answer, and things just surprise you. Same thing with interest rates. Alan Greenspan taught me a long time ago. Taught me just through studies. You can't predict interest rates, and if Alan Greenspan in his prime couldn't predict it, then certainly not many people could. Yes?
I was gonna say, usually when the economy starts cooking, we start using a lot more fossil fuels. Is that happening, or like, I'm surprised?
Well, the production is, the economy, the world economy looks like it might be slowing a little bit. That could also have something to do with the price of oil. Fossil fuels are used a lot less than they used to be because of the advent of efficiency and electric cars and so forth, as well as natural gas. Certainly the world economy has, and I'll discuss that in a quick slide. Certainly the world economies could definitely influence the amount of fossil fuels that are being used, but the economies are, I think at worst, the world economies on average are growing at 2% per year. That's pretty decent growth for a world. Even if it went to 1 or 0, it's still pretty darn good. Even if growth went down 2%, that's still a lot of energy being used. I heard you guys talking before about oil disappearing, but you don't think that's no longer the case. That's what we grew up hearing, right?
Oh, yeah.
We grew up like.
Well, now because of shale.
Carter,
Dirty.
back in Carter's age, we were gonna run out of oil in
Yeah,
20 years.
I remember being in college. I graduated in '81. We felt there'd be a good chance. We were
Yeah.
taught a good chance we'd be out of oil by now. Somebody had a question, or did you have a question, or? I'm sorry. Now this gets to what you mentioned. Here's a 10-year chart of copper. We're a little higher than we were 10 years ago. Through November 7th, we're down about 17%. That's improved a touch the last few days. Copper's an interesting to watch. Interesting thing to watch. They call it Dr. Copper. Dr. Copper. Why is that? Because it's used in everything. Oil's not necessarily, well, oil's used a lot, but copper is used in everything. So it's a good indicator of the future. So I get concerned when I see it down 16% year to date, but that could be a blip. But it's certainly something to watch and something I watch daily. On page 25, you can see our 10 largest holdings, what percent of the assets they are, what their price was at this time, what our cost was, and how long we've owned it. You can see we're typically long-term holders of companies. I put AIG twice because we bought it in 2005, sold it in 15, and bought it again in 17. I could be wrong on the dates a little bit on the 15. Even now, it's 15 days later, and our holdings are very similar. Yesterday, Conoco was like number 11 or 12, and I think Alaska Air was number 10. But that's a good reference, and I need to emphasize that we are long-term buyers and holders. This year, we sold a lot more companies than we have in a long time. Some of my favorites that I've held for a long time, Walmart and JP Morgan Chase. And hopefully we'll buy them back one day at lower prices because they're both, I think, are both great companies, especially JP Morgan Chase. Here's our 10 largest gains this year. Axon Taser. We no longer own Taser. You know what tasers are. Oh, well, the taser is the thing that shocks you, but their real claim to fame is evidence body cameras. But we sold them because I just felt the price was way out of whack. And here's our biggest losers. Helios and Matheson. I'll talk about it later. That's MoviePass, if you ever heard of it. 99.9% we lost on that. Terrible. But with all these losses and gains, we still, as was earlier, I didn't even go through it, we were still at this point up 9.2% on our portfolios when the S&P was up about 3%. I could be wrong on that, but it is in the handout. This is an allocation chart of where our typical portfolio, well, what all of our portfolios have. So you see in order of what we own. Cannabis, we all know what that is. That's a big emphasis in our portfolios. If anybody ever had concern owning it, you just let me know and we'd sell it. Power and energy certainly is bringing our portfolios down at 29%. The utilities, if they dropped, I would love to own them. Those are my favorites. Page 30 and 31 shows you everything we had in our portfolio as of October 31st. We have 42 positions. Really, this one's a kind of really shouldn't even be counted, XLU. It's just a holdover. It's a utility ETF. So you can see that, well, even in our top 10, we have a lot of utilities, a lot of oil, Conoco, pretty concentrated there. This slide is things I think about all the time. Something I found over the years, clients would call me if they desire safety, and inevitably I would tell them, don't go through us for safety because interest rates were so low, and then we have to charge a fee. It's just not. It makes no sense. So what we would say is, go to a bank and get a CD, a certificate of deposit. Make sure it's FDIC insured, etc. But don't go to a bank and get talked into a product or anything like that. Inevitably, people tend to go to the bank and they get talked into a bond fund or something. I'm like, well, they go, that's safe, right? I'm like, well, is it a treasury fund? Is it only treasury? Sure, that would be safe. Or is it high yield, another word for junk bonds? And they typically don't know, so it's concerning. Safety is very important in someone's life, especially depending on their temperament. So CDs are a great alternative. There's you can't, well, treasuries are safer than CDs, but if a CD goes bad across the land, we're in trouble. FDIC probably wouldn't be able to pay it. I spoke to someone a few weeks ago that, once again, I gave them that advice: go get CDs in pure safety. And what they did was get a product that's tied up for 3 years. They don't know what the product was, but it guarantees them a rate of return of 7%. And I find that impossible. You can't get a guaranteed rate of return 7% in 3 years when the 3-year treasury was going for, let's say, 2%. It's just not possible. So we'll see how that works out for them. Now, we never offered our clients, not never, up until now we didn't offer CDs to our clients. But now we're seeing that the rates of CDs are pretty decent. And if a client wanted to get CDs, they can go to a bank or they could contact us and see what we have to offer. And we're been working with a few few clients, and we found ways to get CDs. We don't charge for that, but we have to set up a separate account because it would bring down our performance in a bull market and would bring it up in a bear market, and we can't report that, but we would do it as a favor. And CDs nowadays, you can get 3.5%, whereas a few years ago, you could only get 2% tying it up for 5 years. We still do not have any fixed income in our portfolios, only because of interest rates. They are edging up, interest rates, and if they got to a 6% level from the current 3% level, we would probably have them in a lot of our portfolios. Back in pre-financial crisis, fixed income, quality fixed income was a good 30 to 50% of our portfolio. Things that concern me is price-earnings ratio compression. Is everybody familiar with price-earnings ratio? If not, I can easily explain it. PE, would you like me to explain it, or do you all know it? I assume you know it then. So a company like Gazprom, which is financially strong, just like Exxon, well, they sport a price-earnings ratio of 4, meaning if they earn $1 a share, they sell for a price of $4 a share. Whereas Exxon was selling for near 80. If they had a PE of 4, they'd be selling for about 18. They earn a little bit, let's say $4.25 a share, so they'd be selling for 18. That worries the heck out of me, and there's nothing you could do about price-earnings ratio compression. On the bright side, it's been very rare that price-earnings ratio in America has been less than 10 on average. That typically happens in crises, such as 1973 through 74, as well as a little bit in the crisis of 2006 to 9, or 7 to 9. But that's something I always think about, because a company could be doing very well, and all of a sudden their price-earnings ratio adjusts, and the only thing that changes is their price of their stock. If it did happen to Exxon, the salvation would be, the dividend would be a lot higher than its current, I forget what it is, so probably around 2.5%, 3%. Another concern of mine is what we're hearing a lot about lately, is if there's a trade war. No one wins in a trade war, tariffs with China, with Europe, etc. And that could have an effect on the market. If there was a trade war, well, perhaps less items would be bought from America. Perhaps not even perhaps, our costs on our items would go up, combined with higher interest rates. So you inherently have lower earnings. So it's something to be concerned with. Nothing we could do about it. Hopefully we don't have a trade war. I'm guessing we won't. But we'll see on that. Interest rates, the same thing. As interest rates go up, borrowing costs go up. So interest expense goes up and earnings will go down. And I'm always on the lookout for that. If you notice in your, for our clients, the companies you own typically have lower than average price-earnings ratios. If you had any question on the PE of any of your holdings, I have them very handy. So I watch interest rates really closely. There's a saying, don't fight the Fed. Jeff, your friend Chris was a big fan of Marty Zweig, who I was a big fan of, and he always said, don't fight the Fed. And Marty Zweig, I talked about this last year, he died several years back. And I remember when interest rates started rising in 2005. And I had the chance to speak to Marty, and I said, we have a bunch of Fed rate increases, so why are you not bearish? And he said, well, because interest rates are so low, I would not get concerned unless the federal funds rate was at 6%. Then I'd start to freak out, is what he said. Well, at that time, the federal funds rate was 3%. At the low of the market, it was 0.36%, and now I believe it's around 2.9%. I don't, yeah, right now it's, I'm sorry, 2%. So it still has a way to go. So even though rates are rising, I'm not getting that worried, but I always think about what would Marty do? And would he still consider 6% too high, like he said 13 years ago? But he's been dead quite a few years, so I won't find that out. Like I said, we like to see I like to see low price earnings ratio. When I see Gazprom, that's the lowest PE ratio I've ever seen from a healthy company. My guess is the reason is that Russia is the whole world is concerned with Russia and so forth. I study Russia a lot, and I guess it's a concern. Well, I think that's the reason. One day, I think Russia will be friends with many, and I think that PE of 4 will disappear and go a lot higher, which of course would make the stock go a lot higher. So when I see a price earnings ratio of a company, I also like to see their earnings growth to also be the same or higher than their price earnings ratio. And I measure two things. One is return on equity, and every company has what's called a book value. How much is in their pocket? And so that would be, so then the return on equity is how much money they made in income divided by how much is in their pocket, their stockholders' equity. Well, sometimes that could be disguised with debt. So a company could have high debt levels, which is concerning, and high returns on equity because their equity is low and their net income is high. So I also like to see what's called return on invested capital. And basically that's taking the book value of of what's in your pocket, the book value, and you add back the debt. So if you see a big divergence between return on equity and return on capital, there's a concern, and usually it's too high level of debt. So we try to avoid that. I really like to keep it as safe as possible, even when you're nearly 100% invested in common stocks, which again, historically has not been the case, but since the financial crisis and the plummet of interest rates, that's how we've positioned ourselves. Last year I mentioned my concern with an inverted yield curve, and still a big concern. There's never been an inverted yield curve where a recession has not followed, at least the last 7. Now, what is an inverted yield curve? If you get a A one-year CD is going to get you about 2%, a little higher. A 5-year CD, so 1 year 2%, 5 years 3.5%. Well, that makes sense. You're tying your money up longer. You should get paid for it. Well, an inverted yield curve makes the longer-term interest rate less than the shorter-term interest rate, and that's a concern. Typically, it's a harbinger of lower growth. Something's wrong, often wrong, to cause an inverted yield curve. Now we see here, it very rarely inverts, but it did invert here in 2008. The green is the 2-year and the blue is the 10-year Treasury. And you see it's getting real close here, so it is concerning. It's something I watch. If it's flat, it's concerning, but it's certainly not an accurate predictor of recessions. Now recessions, if those who've known me long enough or ever talked to me, they're natural. Recessions are as natural as cold weather in New Jersey in January, February. Today, the weather, not natural. It's not natural, but it happens. There's a fellow named Dr. Gary Schilling, who's my economic hero. I met him by chance in 1988. A friend of mine took me, owns a talent agency, a very large talent agency. He took me to a Shakespeare's festival, and he's like, "Hey, Ron, look, there's so and so." He's pointing out all these actors. I'm like, "Robert, Gary Schilling is to my right. He's like Babe Ruth to me." And at the intermission, I said hello to him. He asked for my card, and we've kept in touch ever since. He's a great economist. You might have seen him on TV. He's 84 years old, and we had lunch last week together, and it was such a nice time. Very interesting. He was, I believe, he was the head economic advisor for George Herbert Bush. So he showed me pictures of him with Reagan and him with President Bush. And I'm looking in the back corner. I'm like, "Is that you with Keith Richards?" He's like, "Yes, it is." And he told me a great story of how Keith Richards stayed at his house in Fire Island one weekend. And he said, Gary's a very conservative man. Obviously, Keith Richards isn't. And he said it was quite an interesting event. Well, why do I bring it up? Because Gary, as I read his ratings every month, he did something in the last 2 months I've never seen him do, and he was very firm on something. He was like, "This will happen." And I just never recall him saying that, and we talked about it. He said for sure we're going to have an inverted yield curve. Will it be in a week or will it be in a year and a half? He doesn't know, but he is convinced we will have an inverted yield curve. And I was surprised that, "Gary, you've never been so firm." And he goes, "You know what, I probably shouldn't have been, because that's how you look bad if it doesn't work out." But he's pretty darn firm on it. He thinks, yet he's also a treasury bond bull. So I said, how do you think there's going to be an inversion, or know there's going to be an inversion, and still be bullish on treasuries? And he feels that long-term treasuries will go down in price, and short-term treasuries will go up in price, especially with the Fed raising our rates, probably another 50 basis points. And he was very clear to me. He goes, "Ron, my job is to predict what will happen, what I think will happen, not what I think should happen. My job is to predict what will happen." So I said, "Gary, so if I ask you, should Powell and the Fed be raising rates? You would just say, I think they'll raise it 2 more times, 50 basis points, but I won't say what I think should happen." And he said, "Exactly." I thought that was great. Recessions and corrections are the norm, and we're going through a correction now, and who knows if we're starting a recession. For the first time, we're starting to see talk of global slowdown. I watch economic indicators monthly as they come out, and we've certainly have had strength in most aspects of the economies. But we're starting to see, we'll see, they're published once a month, we'll see how they are next month, but we're starting to see some possible strains. But you can't predict recessions, so, and certainly corrections. We won't time the market, so hopefully we'll have some dry powder if markets correct, and we would buy more of it. Because of the weather, less clients of ours are here tonight. We bought Movie Pass. Each year I say, I wish we never bought. 2 years ago it was Valiant Pharmaceuticals. Last year it was Frontier. This year, our biggest loss we've ever had for our clients, Movie Pass. Helios and Matheson. Movie Pass. I hope you don't mind my slight curse. Me and my wife, we call it, oh, no, I told her, movie ass. So we've never lost more money on a stock, but we also had a small position. So as of the end of October, we lost this money, let's say back in the summer, we finally sold it. We were still up a little over 9%, even with Movie Pass. What a great thing it was to have. We got to go for $8 a month. We can go to one movie a day every day. Now we can't even find a movie. We expire in 2 weeks. But I'm sorry I made the mistake. But to err is human. There's a company we own. Yes, Alan.
I know she sold Walmart, you had said in the prior one. Did you consider replacing it with something similar, or you don't think anything's
Well, what would be similar? I don't know. Any. No.
Target.
big box?
One, I'm very. You have to invest in what you know and what your core competences are. I have a weakness in 2 industries, retail and restaurants, and I typically avoid them. Walmart was a different story. Walmart we owned because when we bought them, they were at the same price they were 10 years prior. But I felt the value was there. The price-earnings ratio came down. Their returns on equity, ROE, and returns on capital were high. Their debt levels were low, very healthy. So I felt it was just a matter of time, just like Gazprom. And certainly it did. They came into their own, even against Amazon. But once again, their price went up to a point where I was no longer comfortable with owning them. But no, we didn't replace it. On the other hand, we have 42 holdings, really 41, because we have over 40 holdings. Ideally, we would like to have 15 holdings. Know those holdings well. But right now we have 42. I don't see that changing anytime soon. Part of the reason we have so many is, well, I'll get into that shortly. Because I'll get into that shortly. I mentioned that we invest in utilities. Utilities typically are safer investments, give a nice rate of return. Of course, an Exelon, or really any utility, could have a nuclear mishap. Hopefully that doesn't happen. But that's an event that could really hurt a utility. We typically have in our utilities, what page was this? If you look, 5% in First Energy, almost 5% in Exelon, 4% in PPL, and down the line. Well, look at number 15, 3% in Pacific Gas and Electric, PCG. Is anybody familiar with them and what's going on with them? PCG is the largest utility company in California. PCG is one of their transmission lines might have been the site, they're investigating it as to where the California fire started. And that's not good. Not good. Now you can see here, PCG was at 47, we paid 39.50. It was at 47 October 31st. It closed today at $17.50. A healthy utility. Now California has a very interesting rule. If a fire starts near, if a transmission wire or something causes a fire, even though the company has been prudent, has lived up to all safety standards, and done everything correctly, an event of nature, they still are could be held liable. Now, this was a big issue for Edison International, which we own right here, 2% of our portfolio, as a big issue for them, and Pacific Gas and Electric from fires that happened last year, at this time last year. But then they were just starting to settle it, and the state was saying, we understand, this wasn't necessarily your fault a few of the fires were their faults, but none of them, in general, they weren't. So it was expected that the utilities would get relief from the government through rate hikes, through bond offerings, and make it up that way. But now these fires started, and Pacific Gas and Electric came out the other day and said, we have $1.4 billion of insurance, but if we're deemed liable, the outlay will be a lot greater than that. So possible they can go bankrupt. With that said, that's what happened to them. Also, with that said, we're very diversified. It was a 3% position, so it's not the end of the world. Normally, when a company comes out with bad earnings and it's temporary, if it dropped like that, I'd buy the heck out of it. But the truth be told, PCG and EIX might not survive to the shareholders. Jim from my office said, well, how could a utility go bankrupt? What about the people it serves? The people will be served. It's the shareholders and bondholders that will be hurt. But my guess is something's going to happen there. My guess is that's a quality company, and I don't think they're fly-by-nighters, and I think there's going to be some type of remedy. Of course, shareholders should and will feel pain, but I don't think $17 of pain, $17 share price is fair, but we'll see. We'll see what happens there.
Mark, can I ask a question?
No, Jim.
Going back to like when you asked about Walmart before, and the markets have pulled back a lot in the past month or so. How about a company like Amazon that's lost about 25% of its value? Would you consider something like that now?
No.
And why?
Amazon, I've never come across a company that I like as much as Amazon as a company, not as an investment. And of course, the investment's gone through the roof, right? But I think their price-earnings ratio is absurd. I think their AWS, their Amazon, I know Amazon very well. Amazon Web Services was the leader of the cloud. Well, they're starting to lose that lead to Microsoft's Azure and Oracle and Google. There's a lot of competition. So only because of their price-earnings ratio, even though they've gone down, well, it's no longer 25%, but let's say 18 to 20%, I still think, end of the day, I'm guessing they're worth $800 a share, but they're selling for $1,600. But that's the only reason I won't own them now is because of valuation reasons. Doesn't mean it's a bad stock. It's just not for us as value investors. I just don't see them. Well, I guess they could grow into their. They could grow into their valuation, but it's just not for me. I feel too risky, and too many things could go wrong. Look, I got concerned with Walmart with a PE of 22. And they're certainly growing in e-commerce. Certainly, and I always ask him, if you're buying something, just look at Walmart.com. They have good shipping, great prices, and when we were investing in them, I was more focused on it. Same thing. We used to own Overstock. Same thing. But Amazon makes it simple. The only companies I've seen with a higher crazy valuation than Amazon when it was at $2,050 a share is many in the new cannabis sector. And if anybody wants me to discuss that, I certainly can. I will. Does anybody object me discussing cannabis? You're okay with that? You're okay, right? So Yes,
Well,
ma'am.
before you start
Oh,
discussing
yes.
cannabis, I noticed that you got rid of TerraTech Holdings. There is a chance of them merging with Gold Leaf Holdings now. Is there any upside on that, or?
My thoughts on Golden Leaf merging, Golden Leaf, I'll tell you a little bit about that. TerraTech is a company that I followed since 2014. Now, yes, big loss of ours, but once again, a very small, we had very small investment in there, incredibly small. They're a New Jersey company, and I should be careful what I say, but I don't trust them one bit. Golden Leaf, on the other hand, Golden Leaf Holdings is a Canadian company that operates mostly in the United States. Golden Leaf, a year and a half ago, 2 years ago, had a reputation worse than TerraTech, had one of the worst reputations in the industry. But what they did is bought out a company called Chalice Farms. Chalice Farms was founded by a man named William Simpson. And it turns out he basically became president of Golden Leaf, and he threw everybody out who deservedly gave them the bad name, and he basically started fresh with Golden Leaf. Basically, Golden Leaf's name existed where Chalice Farms is really the company that's fueling them. So as much as I don't trust the president and CEO of TerraTech, and TerraTech, Derek Peterson, he used to own maybe 25% of the company, and now he owns about 1% of the company, as opposed to William Simpson, who owns about 20 to 30% of Golden Leaf and Chalice Farms. So for me, a company I admire, Golden Leaf, merging with a company I don't like at all, I'm very disturbed by it. I hope it falls apart. I don't want them to merge. Chalice Farms is a quality company. Everything they do is quality. And they're not hype. They tell it like it is. It reminds me of a Canopy in its early days, Tweed, which is now, a $15 billion market cap. Did I answer your question?
Yeah, that's fine.
Now Golden Leaf, certainly. Now Golden Leaf, as much as I like them, they don't have great finances. But they are a leader of the industry, and we'll see what happens there. But I'm very concerned that they merged. The reason we're invested in the cannabis space is because I think we're in an era of a new paradigm there. I think it's clearly the stigma of cannabis has changed. Canada, it became legal in Canada recreationally October 17th. Canada is the first G7 nation to legalize cannabis recreationally, and frankly, I think the United States is going to follow sooner than later. And if that happens, then we have almost prohibition, just like prohibition here in America in the early days. We have a relaxation of prohibition here in the cannabis space. John Boehner, the former Speaker of the House, he's a board of a director of a company that came public today called Acreage Holdings. Here you can see cannabis is either recreation or medically legal in over 50% of the nation and the whole West Coast, recreationally and medical. I'll get back to Boehner in a second. Canopy growth, is the leader of the cannabis industry. They are the 500-pound gorilla. We own them. We bought them at $1, split adjusted $1 something a share, and we finally sold our last pieces this year at $30 a share. We'll never have a return on investment like that again. Some of our clients, when we first bought it in 2014, we asked clients first, and some didn't. It was so new, I put it out to them, and they just didn't want to own cannabis, and we didn't buy it for them, but a lot of our clients had it. But it got to the point where I just felt that they could never grow into their valuation. They're selling for $15 billion as a company, and their annual revenues, now that it's legal in Canada, maybe it'll hit $350 million next year. How do you turn $350 million in revenues into $15 billion of price? I don't think that's sustainable. Constellation Brands bought 15% of Canopy over the last 2 years. Constellation Brands owns Kim Crawford Wines, Corona Beer, the Prisoner Wine. They're a huge spirit company, and now they own a lot of Canopy, but I think they paid way too high a price. You know, I was researching a company called Ballast Point that was going to go public several years ago. Their symbol was going to be Pint, P-I-N-T. They make a great beer, and my beer drinking, when I used to drink more beer, and I think Tom will agree, they made a beer called Sculpin. They make a beer called Sculpin. So I did a lot of research, and I said, great, if this company sells for less than $1 billion in market cap, we will own it. Well, 3 weeks before they went public, Constellation Brands bought them, so they never went public. And I thought they overpaid there as well. So I think that our general theme on cannabis is that it's in the early stages of a worldwide legalization. And I've studied it quite a bit over the last 4.5 years. And it seems to follow the same pattern as alcohol did in the Prohibition. Prior to federal prohibition, various states had alcohol illegal. And then the feds just threw up their hands and said, fine, it's just going to be illegal everywhere, and that's what happened. And the world also followed, but then soon it relaxed and it became legal worldwide again. And you're seeing the same, I think we're seeing the same thing with cannabis. We're seeing what appears to be worldwide acceptance. Very few countries that I know of don't accept it at all. This is interesting. John Boehner, I watched a video 2 days ago, and I was just shocked because he was very anti-cannabis. And the things he said in this video, and it's in the handout, and you can and soon the handout will be on our line, so you can just click on it, and you can see this video. It's 60 minutes. It's somewhat of an infomercial, but I believe he's telling the truth. And he thinks this is going to be huge. And he did have a recent op-ed where he urges the federal government to not necessarily make it legal, but to reduce its Schedule I status. It's basically listed as bad or worse than heroin. And because of that, there's what's called IRS Code Section 280E. And he says that needs to be reformed. And very interesting, he says the timeline will be measured in months and not years. And he also says that President Trump agrees with him. 280E basically says, I'm going to be very generic here, because it basically says that your expenses of a marijuana company are not, of a cannabis company, are not deductible. That is very prohibitive. Imagine you can't deduct your rent, your salary, your advertising. That's tough. Imagine Alan or any of us in business, if you couldn't deduct your expenses, that's difficult. So we'll see where that pans out. As you saw in another slide, a little over 7% of our investments are in cannabis. The biggest one, surprisingly enough, is Scott's Miracle Grow, which most people don't realize is a very huge push into cannabis. And then you see, this is why we have so many companies. From here, CanTrust, which came out with earnings yesterday that were just phenomenal. I think it was up 25% today, CanTrust.
26.9.
Okay. Is that something? And it was funny because I tweeted it, just last week they lost their president and a chief operations person, and they didn't even announce it, and that concerned the heck out of me. You gotta tell the people what's going on. So I put a tweet out there about CanTrust, what I thought their earnings would be. Oh, our revenues were much lower than expenses. Our liquidity is, this is made up. Our liquidity is terrible. We're running out of cash. No one wants to loan us money. And that's the bad news. The good news is we just got Geico. I think I worded it more funny, but anyway. And you can see Golden Leaf, like you mentioned, Matt, and then a bunch of others. And there's a few on our, well, no, there's only one on my buy list, which I won't mention if it hits a certain price. I won't mention what that is. Iantis here, also a good name. We sold half of our position at a much higher price, but it's also a really good company. Iantis is real big in New York, and they're building a facility in Warwick, New York. And most of these companies are what's called vertical integrated operators, where they, from seed to sale, they develop the plant, they sell it to their own retail stores as well as other retail stores and so forth. One of the big problems in cannabis is that they've experienced great deflation, where, this is where I need to refer to my notes, but I believe a pound of cannabis used to go for $2,800 wholesale to retailers. And now, for high quality, they're lucky to sell it for $1,200. That's a big drop, especially if you had a business model with debt based on a certain amount of production, a certain amount of revenues. But the strong will survive. And that's why I have so many, because if two of these survive, great. I imagine CanTrust is going to be around a long time, and Iantis. Golden Leaf is, I think, a great organization, but they certainly have cash flow concerns, at least in the future. They sell for 15 cents a share, and I wrote a note, and I've spoken to him before, William Simpson, the president, urging him to do a reverse split. Like 1 for 2,500. Make the stock $50 a share. I think everybody thinks that's awful. I think it's a great idea. I think it would bring a lot of interest. Where, who wants to buy a 15-cent stock? Well, now it's 13 or 14, or you know better than it. But I said that because it was up 26.9%.
It's actually, well, it's 29.06. I just looked at it. Regardless, I wanted to day trade it today because all the good news I was on it yesterday. They want to be on New York Stock Exchange.
Yes, they want to go to New York, which I think is a great idea, and I think they will reverse split. I think that would be fantastic.
That did plummet everything else though. I mean, Aurora Cannabis went to New York Stock Exchange and went down from about 10.50 down to 6.70.
Right, but they all did, and Canopy went from 50x to 30, and now it's up to 37.
Seemed like it was just bad news when they went there. But who knows?
Now, Scott's Miracle Grow is real interesting, and we all know Scott's Miracle Grow. They own they don't own Roundup. They're a distributor of Roundup, and their Roundup has a lot of issues going on. Scott's Miracle Grow insists that they're just a distributor, that they have absolutely no exposure. Their exposure is if Roundup becomes obsolete, they lose the revenue. And of course, they have fertilizer. But Scott's Miracle Grow, they're big. They're big in the cannabis industry because cannabis, for several reasons, is typically grown indoors or in a greenhouse. It used to be that the reason it was indoors the best place to grow cannabis would be indoor because it's a controlled environment, and they could really focus on the quality without interruption, without weather messing them up. The problem is it costs a lot of money. So then greenhouse also is a viable alternative, especially with the technology of greenhouses is getting much better. In certain areas, outdoor grows are fine, but a place like Hawaii at this point doesn't want outdoor grows because they don't want tourists to see marijuana fields. But that stigma's starting to change, so that could promote outdoor growing, as well as new technologies allow for the quality not to be as important. If someone's looking just to feel the effects of cannabis, the quality is not that much different based on manipulation from outdoor to indoor, but I guess if somebody's doing it for taste or whatever, then indoor would be better. Well, the reason I mention that is if you're going to have an indoor grow, you need an infrastructure of lights, vents, fans, tables, computers. You need a big infrastructure, expensive infrastructure. Scott's Miracle Grow is the largest company. They are the 800-pound gorilla in the infrastructure of indoor and greenhouse infrastructure. The infrastructure of that, which is necessary. Interesting enough, it was presented to Scott's Miracle Grow. Well, now that outdoor is going to become more popular, what happens to your, well, they call it the hydroponic division. Hydroponic they define as anything related to the indoor cultivation of cannabis, not just water, which is most people think of hydroponics. And they said, well, sure, in parts of California, Hawaii, the weather is conducive for that. But then you have the next 3 big states to go legal, that they think will be legal, will be New Jersey, New York, and Connecticut. And they said New Jersey's going to probably be the first, and then New York will probably follow because they don't want their neighbor to steal all the revenue. So those alone, it's not conducive to outdoor grows or weather, so they'll still have plenty of indoor, and those 3 states are as big as California in revenue expectations. And one of the reasons we bought Scott's Miracle Grow is I felt it was misunderstood by many, including in the industry. Many thought, oh, it's just a blip on their, yes, they're big in cultivation, but it's just a blip on this big company's revenues. Well, it's not just a blip. It's going to be 15% of their revenues next year. It's a big part in growing. It's a focus. Other companies say, and I spoke to a lot of cannabis executives and analysts, well, it's hydroponics. Nobody does hydroponics anymore. It's nothing. It's not really water-based. And it's because their terminology is bad. Hydroponics is, they made it clear now in a lot of their writings, but they need to make it clearer. It's really the it's anything to do with the infrastructure of indoor. And that's why we bought it. But unfortunately, we bought it at 81, and now it's about 77-ish. So it's really gone up. But here, it was at 66. I think it's a great company. It's a pick and shovel of cannabis. The pick and shovel is what a term that was referred to during the gold rush. The pick and shovels were the ones that sold. One second, Mrs. Krause. Now, not everything's great with Scott's Miracle Grow because they do have a heavy debt load. It seems very sustainable, but they do have a heavy debt load, and we'll see. But they're not distressed debt, but whenever there's debt levels, if you hit a major recession, what if they have trouble paying off their debt? I don't like companies with high debt levels, but I make exception here. And if they didn't have debt, it would not be a 3% holding, it would be a lot higher. And if it went to $50 a share, we'd be buying a lot more of it. Yes, Mrs. Krause?
Ron, is that the same Miracle Grow that I use on my geraniums in
Yeah.
the summer?
It's the same company.
Same company,
Yeah.
but there is a Miracle Grow product.
The name of the company is Scott's Miracle Grow. The product you're talking about is yes, it's the green thing, it's Scotts Miracle-Gro. That's the name of their company, but it's the same exact product. And they have so many products here. You know, I'm gonna, well, here's their, you know, I forgot I had this. But they, on pages 55 to 57, I discussed Scotts Miracle-Gro. Now these are things we probably never heard of because they're because they're in the, you know, the infrastructure of cannabis. Who the heck knows that? I wouldn't know any of these even if I saw them, even though I know the cannabis sector. But that's a good example of something we own and why we own it. We'll see what happens there. Alan, you had a question?
Yeah, this may be a dumb question, but so Canada, they made it legal, and if they bring it to the United States and legalize it, would you find that people will be allowed to just do it on their own and not have to go through all these companies, and would that suppress the company, just like you could make alcohol for your own use?
Well,
Or was that even a different industry that you?
well, we can make beer for, Tom over here. Tom and I are craft beer drinking buddies. We really like a world-class beer. But, you know, sometimes we have friends that make it, but you still go out and buy it.
Just like you buy tomatoes, you don't buy tomatoes.
Yeah, now, but there's caveats there as well, though.
They do.
There's caveats there. Remember, it's cannabis, marijuana, the nickname, weed. It's called weed for a reason. It grows like a weed. It's very simple to grow. New Jersey, who's going to be putting it up and hopefully discussing it this month, and very well might become recreationally legal at the end of this month. I believe it's November 26th or 29th. I forget when they're voting. It's not voting. It's just being presented to the legislators. And if they all agree, it goes to the government, to the governors for signature, and there's no vote, just like they did in Vermont. I believe New Jersey is going to have a no-grow policy, and if I'm not mistaken, Canada has a no personal grow policy. So if you grow it, it's illegal. But once again, do you drink wine? Do you make wine?
It seems kind of illegal to prohibit it.
I don't know. Are we allowed to? I don't know. I don't know the answer to that. In California, you can grow it if up to X amount of plants.
I think Vermont you can as well.
I believe you can. Interesting, as I showed you the map of the western states, all legal. Well, the eastern states, the upper northeast, it's legal, but they have no ability to. It's nothing. Well, Massachusetts just started opening their first recreational dispensaries just a week or so ago, and it's been legal for 2 years. Michigan just voted it, and I'm hearing that it could be up and running in 3 weeks. New Jersey, I think, will be up and running very quickly. But we'll see. Here's another company we own, a very small company that was introduced to me by a fellow who's been to quite a few of our events. A fellow investment manager, really nice guy, and he took me to their board meeting. So Brunswick Bank is a real small bank in New Jersey. I love buying banks when they're selling below book value. Historically, banks have sold for 2 or 3 times book value. So if they were worth $1, they were selling for $3. Since the financial crisis, that changed quite a bit, and that's why we had and have such a large financials in our portfolios. They're still selling near book value or fewer below book value. The reason we sold JP Morgan Chase is it was selling at almost 2 times book value, and I just, at this point, not ready to invest in it with that type of metric, even though it's historically low, but not if you look at the last 8 or 9 years. This company, Brunswick Bank and Trust, as my friend introduced it, a company you cannot trust, a little bit shady. Their CEO owned 34% of the company, And we would have a lot of discussions, and he wouldn't pay a dividend. He says, I won't pay a dividend because we want our company to be financially strong as they are. They're really a financially strong bank. I think they didn't pay a dividend because he owned 34% of it and didn't want to pay tax on the dividend. Why would he do that? So there's no liquidity. If it had liquidity, like if I was able to buy it and sell it like that, we would have a 5% portfolio position. But we can't buy and sell it like that. We own 80,000 shares, which is about 2.6% of the company. If we had to sell it based on average trading volume, it would take us 80 days to exit our position, as opposed to, if we had to sell Merck, it would, take a minute. That's a negative. Now, what happened is they were selling for about 40% of book value, if I'm not mistaken. Yeah, when we bought it, it was 44% of book value. Now it's at 68% of book value. It went up a great deal this summer. And once again, they're very healthy. They have high capital ratios. Now, why they go up so much is because the man, a very nice man, mid-50s, passed away this summer. The day after he passed away, this company the stock went through the roof. And I guess the reason being is people think it won't be their piggy bank anymore. And he passed away. He passed away on July 11th at $7 when it was at $7.23. The next day it was trading for $8, and then it went up, and now it's down a little bit to $8.50. It went up to 9 and change. But where I would own Bank of America, Citibank, J.P. Morgan, AIG, I would probably own them at close to 1.5 times book value, if not more. This company at book value, I don't think I'd own too much of it, but we'll see. I think that's all I have to say. Does anybody have questions?
I have a question.
Sure thing.
Somebody's talking about the differential between inflation and was it the 33-month treasury bill?
Well, we weren't talking about that today, but that's, I believe,
No,
called the
I know.
misery index.
Yeah. I mean, you say if it gets down to 1%, then you're headed for trouble.
If what gets to 1%?
The difference.
Oh.
Inflation is 3, and let's say inflation is 2. If it's less than 1%, in other words, if inflation is 2.5 and the 3-month treasury is 3.5, you're down to like 1% differential. And it sometimes, when that happens, historically, there's been a recession. Comment on that.
One, I'd be surprised if it was measured against the misery index. I'd have to look that up. Inflation's been without us for it's called the misery index, isn't it? This is my...
No, it's called I don't know, I thought it was a differential between inflation and the,
I'd be surprised if it's a 3-month rate and not
Maybe it was
maybe,
10,
maybe the 5-year rate.
10 years, whatever.
I don't think there's an exact number. Most of your life, you've probably had up until the last 15 years or so, an inflation rate might have been greater than interest rates. I think normally they're supposed to be at par with each other, and that's why I think the Fed wants to bring interest rates to 2.5. Is it 2.5%? I don't know the answer, but I don't think when there's a big divergence where inflation is much greater than interest rate is where the concern is.
Yeah, the Fed rate, I'm sorry,
Yeah.
it said 3-month treasury.
Right, the Fed rate, which is at 2% right now,
Right,
probably
so-
go up to 2.5%.
So if a differential is less than 1%, then you're headed for a recession.
I don't know.
No?
I haven't heard that.
You
I'm
haven't
sorry.
heard
The only surefire thing, and not to say I'm wrong, I might be wrong. I'm
Yeah.
not saying, I just haven't heard of it. The
Yeah.
inverted yield curve for sure, and I think
Yeah,
I think
yeah,
inflation
yeah.
rates are supposed to mimic Fed funds rate,
Yeah,
and we're seeing signs of inflation. Boy, we're seeing at it at home with our housekeeper or various things. We're seeing inflation. Let's just see what happens there. Now with oil going down quite a bit, maybe we won't feel the effects as much.
But oil going down too is a sign of recession, right?
Potentially, yes. Deflation
So aren't
could
we
be
headed-
if it's
Aren't we headed there?
to a recession.
Yeah.
I would guarantee you at some point in the next 50 years we'll have a recession or two.
I'm talking
Or
about the
more.
next year.
No idea. Who
I'm
knows?
telling about the next year.
Could be. I don't know. You can't predict recessions. You can't. It's just not possible. I don't think. I don't think you can predict recessions, Henry.
Right.
And often we go into a recession and sometimes we don't even know we're in a recession until we're coming out of it. You know, it's trailing numbers. They're always adjusted. But it's something I watch for sure. Inflation and interest rates. If inflation went way above interest rates, that is definitely a concern because you lose nominal value. So, yes.
What you say? What do you think the effect of our president's behavior, good or bad, on investing in the next 2 to 6 years?
I'm not going there. I'm sorry.
No
I
offense.
prefer not to answer that.
You just cancel it out, or? Yeah.
Look, I think it increases risk just because, maybe he says things that he should be saying behind closed doors, but tells us, you don't wash your laundry in front of your children, dirty laundry, but I'm not going to share my thoughts there. I apologize. Yes, Matt?
I'll ask one last question.
Keep them coming.
There's a company trying to break into the cannabis space, from what I've read, called Sugar Meat, that wants to be in the hydroponic, area basically.
Meaning cultivation, not
Yeah,
water.
cultivation.
Okay.
You hear anything about that company?
I only read about them for the first time last week, and it just went in and out. There's also a Grow Generation, GRWG, I believe, is in
I
it.
think that's one too, yeah.
Yeah. You're always going to have competition.
Yeah, they were just mentioning an article.
Yes.
Scott's Miracle Grow. I was just curious about it.
Yeah. I guess my thoughts on Scott's Miracle Grow is you have the safety of a big conglomerate. If you are opening up a major cannabis operation, you must at least consider Scott's Miracle Grow. If you didn't, I think you'd be susceptible to reprimand. Not to say that you'd end up with them. But, in Scott's Miracle Grow, right now things will change because of legality in Canada, but right now the biggest revenue producer in the cannabis industry is cannabis directly is Canopy Growth in Canada. And they were hoping to have 100 million Canadian dollars of revenues this year, which would be 76 million US, and they didn't hit that as they reported a day or two ago. To put that into perspective, next year, Scott's Miracle Grow will probably have, and I'm going from memory here, I shouldn't, $350 to $400 million of revenues, and they're calling that slightly depressed. So it's a big company, it's a big thing, but sure, it's wide open. I do know, my son works for a very large cannabis company in Oregon, and he had me speak to their head grower, their lead grower. And they try to feed the little guy, go away from the, I think what he called it, the Walmarts, and go to the mom and pops. And they try to avoid Scott's Miracle Grow. Their hydroponic division is called Hawthorne. And they just bought out a big company called Sunlight Supply. Well, they try to avoid that, but then when he said, now that they bought Hawthorne and now Sunlight Supply, it's really hard for me to ignore them. But there's always going to be competitors, and that's the nature of the world. Any other questions? Well, thank you all very much. I'm sorry it's such a small turnout, and thank you. I'll be putting this on the website, and anybody, client or not, feel free to give me a call. I'll always get back to you, but I might not, just like I wouldn't give you an answer or couldn't give you an answer. I could have, but I wouldn't. I don't even know if I could. I don't even know if I know the answer to that. But, give us a call. We have everything till 10 o'clock, so I'm going to have a glass of wine or two. So feel free to hang out and stay, and there's still some food. And thanks.